Hello and welcome. I'm absolutely delighted you could join us today. We have a wide variety of different people from many countries following this online event. My name is Simon Osborne. I am the CEO of IFI Global, which is a research and media house based in the City of London. We have 4 publications, and one of them is the ESG report, which is becoming an increasingly important part of our overall business. Now, I have on the panel today, there's always a slight time lag between me clicking on this and the second slide coming up, but we get there in the end. Oh, it will get there, promise. Okay. Oh, there it is. As I told you, there's always that slight time lag. We have on the panel with me today Paul Price, who is the CEO of Haven Green Capital Partners. He is based in Dublin. We have Dr. Felicia Shaw, who's the innovation lead at LSCG Labs, and she's out in Singapore and therefore up very late in the evening where she is. We have Nick Wasserman, who's the founder and CEO of Integrated Portfolio Intelligence, and Nick is in New York. And Karina Vaughan is the sales director, ESG and spatial finance at GHG SAT, and she's here in the UK with me. And thank you very much to GHG SAT for sponsoring this event today. I'm going to present the headline findings of research that we have done with GHG SAT on pension fund allocations to the main investment areas across the E, the S and the G pillars. And then we are going to get into the panel discussion. Please use the Q&A button at the bottom of the screen if you would like to ask a question. We may take the odd one as we go along, but we'll try and save some time at the end, assuming we get some questions for those as well. So let's get on to the research. It is our growing view at the ESG report that there hasn't been nearly enough analysis or research done on what it is investors are really allocating to under the extraordinarily large and varied ESG umbrella. In fact, I would go so far as to say that clubbing together, say, on the one hand, emission reductions, and say, on the other hand, social housing under the same ESG label can be misleading, can be unhelpful, as well as being helpful, no doubt, in some respects too. But assets in ESG overall are something probably just above $35 trillion globally, and one would have thought we should be getting much better and much more precise breakdowns of where the actual money is ending up. That is why we were keen to do this research. A researcher at IFI Global looked at the websites and sometimes the annual reports of the largest global pension funds out there to analyze where their ESG investments are actually going. She found 52 of basically the largest 100 in the world where did provide us with the kind of information that we wanted. And an important point to make about the other 48, it's not that they're not investing in ESG, it's just that we were not able to get that kind of information. And by the way, of those 48, and indeed perhaps many of the 52 as well, it's important to say that when you go to what they're doing on ESG, they make a big point about the fact of what they're not investing in anymore. Cancelling out of investments in non-ESG approved areas, I think, is easily the most common way that pension funds are approaching this at the moment. The 52 pension funds that we got information on, as you say on the screen here, have $5.2 trillion in combined assets, and they are many of the world's best pension funds. I'm going to come on and show you some of their names in a minute. Now, these are the top 8 categories that we were able to find through our research. Emission reductions, as you can see, was top. So out of the 52, you can see just over 36 of them were investing one way or another in emissions reductions. And you can see the complete dominance of the environmental pillar there, which I'm sure is no surprise to anybody following this event today. And FYI, you'll see infrastructure, third from the bottom there. That is a bit ambiguous. Some institutions put a part of what they do in terms of their investing in infrastructure into their social investing category, whilst others do not. This again touches on an issue that we may be getting into in a few minutes' time on the question of definitions. I hope we'll get into a discussion on that in a few minutes. Now, these are the pension funds that are in the have stated that they're investing in emission reductions. As you can see, many of the world's largest and most famous pension funds, ABP, I think it's the biggest one in the whole of Europe, not just the EU and the Netherlands. CalPERS, CalSTR's huge in the US, as you will know, doubtlessly. USF, which is the biggest pension fund here in the UK, and many other very well-known names, you will see there. And doubtless, when we go past this 52, and we intend to carry on with this, we'll find many other examples of major pension funds around the world as well who are doing this. One important point. I'm just presenting the very brief headline findings so we can get into the discussion in a minute. We're going to lay this out in a lot more detail, including the pension funds investing in the other categories, renewable energy and water and all the other things that we had on the screen a couple of minutes ago. All of that will be laid out in detail in the February issue of the ESG report, plus some other stuff regarding the research as well. So, but before we get into the discussion in a minute, I want something that I've already mentioned that is becoming increasingly important to us anyway, is the categorization issues that you get in ESG. And I just wanted to throw up here examples of three of the largest. As you probably all know, there's probably about 100 data providers in the ESG space these days, huge numbers of them. But here are three of the very biggest, and this is just how they approach the main categories in the environmental pillar. I mean, if you did the social pillar or the governance pillar, you'd have the same diversities you have in the environmental pillar, probably more in some respects, in some ways. So the issue here is it's frustrating for anybody and everybody who would like to get some proper definitions going, and something I hope that we will make progress on in the industry going forward. And just before starting the panel discussion, I thought I would let you know what's coming up in terms of our coverage in the ESG report, our ESG publication. On the investment side, as I've already mentioned, we're going to campaign, if that's the right word, agitate, push for better ESG investment categorization. Love to hear from anybody who's got some thoughts on that. And once we've got our 8 to 10 investment areas, we did 8 in this research that we've been presenting today, but let's say it's going to be in the 8 to 10 area. We are going to stick to those, and then we are going to try and really delve into who is investing in each of those areas on an ongoing and continuous basis this year and further into the future, with the goal of developing this thing called, it's got a very ugly name at the moment, we might come up with a better name, I hope, the ESG Institutional Investment Barometer. The idea is that we can see how emission reductions versus water versus nature versus social housing, whatever it may be, how are the allocations to those particular categories going? And as we gather more data and do that, hopefully that will be a useful service to the industry. And then on the industry side, the ESG report, which is the original reason we launched this publication a few years ago, is I do strongly believe ESG practices will change the industry. It's beginning to happen. It's still very early days. I think that will happen more in the future. And when I say the industry, I mean managers as well as service providers. And service providers, I think, should be brought in. And the other thing that we'll be covering very extensively when we get at least to the spring is the second level of the SFDR, which is due to come in, as many of you doubtless know, in the summer. It's already been postponed twice, could get postponed again. But when that does come in, not only everyone here in Europe, but I think everyone around the world will be very interested to see how that does influence and change the industry. I think it's going to have a huge impact when it does happen. Right, so that's enough for me for the moment. Let's bring in the panel. Fantastic, there they all are. And I'm going to ask them first to make brief opening introductory comments, and then we will get into the panel discussion. And to repeat what I said a few minutes ago, please do fire in questions as we go along, and we'll take them either then or at the end. So Karina, can I come to you first for your opening comments?
Yes, thank you, Simon, and good afternoon, everyone. I am Karina Vaughan, and I lead on GHGSAT's business growth in ESG. I'm delighted to join you today and looking forward to a lively debate with my fellow panelists. GHGSAT is the first and currently the only firm to launch satellites into orbit capable of high resolution, low threshold greenhouse gas measurement, measuring down to individual asset or facility level and at a spatial resolution of around 25 meters. Today, we have a constellation of 3 satellites, a demonstrator satellite that we launched in 2016, and 2 further satellites launched in 2020 and 2021, each one gathering 25,000 observations per annum. This summer, we will launch 3 more satellites, and by 2023, we will have a constellation of 10 satellites plus the demonstrator measuring both CH4, methane, and CO2 emissions. Added to this are our aircraft sensors measuring at a spatial resolution of around 1 meter. And so for our customers in energy mining and waste management, we are providing clear emissions attribution and quantification, data that's consistent, that's updated at least monthly, and that is unique. And so climate change and the impact on the environment from greenhouse gas emissions is the most pressing issue facing us today. And for the investment industry, the E is increasingly playing a more dominant role in ESG. And so having access to granular, timely emissions data by individual company or asset, by sector or jurisdiction, aggregated across your portfolio or fund is essential for active investing. And sustainable investing requires an active strategy, not the sometimes passive one that today's ESG ratings and labeling has nurtured. And so for an active strategy, we need robust asset level understanding of all of the different measurements under the ESG umbrella, of which emissions is a key business performance indicator. So whilst pension funds do not directly produce greenhouse gases, the way they allocate their capital has a significant impact on the long-term behavior of the companies and the countries in which they invest, and on the investment industry as a whole. So, Simon, it's good to hear that there is a majority of institutions focusing on emissions reduction. I'm keen in the future to understand a little bit more about how they plan to deliver that and whether their focus is going to be just on scope 1 or also on scope 2 and 3 emissions.
Thank you. Felicia, can I come to you next for your opening comments?
Yes, so thanks very much, Simon and Karina. I'm Felicia Shaw from the London Stock Exchange Group Labs. And just to introduce my organization, LSEG Labs is actually in-house fintech for LSEG. And what we do is we use data science and artificial intelligence, along with engineering and user research, to tackle some of the most interesting problems and futures that face the finance sector. So for me, I'm actually innovation lead for the sustainable finance unit in Labs, and I'm absolutely very, very happy to be here today. I think I would like to kick off by adding a little bit to your list, and I'm really looking forward to that report, by the way, that you mentioned will be released in February. And I want to give a little bit of a flavor, since I'm based in Asia, of how some of the institutional investors are behaving in Asia. So maybe I'll talk a little bit about Japan, a little bit about China, a little bit about Singapore, where I'm based. So as some of you will know, actually, Japan's government pension investment fund is like the largest pool of retirement savings in the world. It's, I think, about 1.7 trillion US dollars. And it's also the largest public fund investor in Japan by assets. And it's interesting, what Karina said about, we need an active management perspective for ESG, because Japan's government kind of uses a diversification and index and passive approach towards investment, but that doesn't mean that they're not interested in ESG. So for their equities part, they're actually using ESG and carbon weighted indices, such as the S&P Global Carbon Index, and I think the FTSE Blossom Japan Index. So in a way, that kind of problem is shifted into the kind of index makers, how they're assigning ESG weightings and how they're scrutinizing the ESG performance. And they also use a combination of different frameworks for things like alternative assets and infrastructure, real estate. So it might at first appear that there's an amalgamated ESG approach for Japan's fund. But if you also look at their governance documents and their governance process, there's particular attention to the tracking of carbon intensity and also whole portfolio GHG emissions, because there is a strong recognition in Japan of things like climate risk, transition risk, physical risk. Then if we look at China, what's going on in China? So I think sometimes China gets a little bit of a bad rap for things like emissions. But they do have a dual carbon goal, which filters down from the very highest level of strategy in the government. And that's to peak emissions by 2030 and then kind of bring down to carbon neutrality by 2060. So we see actually the National Social Security Fund, which is not quite the pension fund, but is a pool of capital that's meant to supplement pensions, as they undergo this very huge demographic change that's going to come from the one-child policy, decades of one-child policy. They actually have a mission and to kind of integrate some of that dual carbon directive into their processes. And the way they've done that is they've actually experimented. So they've kind of just looked at sort of asset managers outside of China and experimented and piloted and slowly tried to take learning points to kind of integrate into their future application of ESG investment concepts. So that's quite interesting kind of place to watch. And the final one that I'll just touch on very briefly is for Singapore. So the Sovereign Wealth Fund, the Government Investment Corporation, GIC, again, not the pension fund per se, but it manages foreign reserves, which kind of have an indirect flow back into Singaporeans' pensions. It applies ESG investment along a few strategies. And it's been very upfront that climate risk, changing regulations and consumer preferences. So the fact that, younger people are actually much more cognizant and aware of environment and climate change, that's what's driving its interest in ESG. So it looks at ESG both offensively and defensively. It's got some passive strategies, some active strategies, both in kind of opportunity capture as well as risk management. And very consistent with some of your findings, I think, in the report, GIC's headline investments have been in themes such as renewable energy, green buildings, and low carbon transition. So with that, I just wanted to give a little bit of a flavor of what's going on in Asia and talk a little bit about kind of the passive active balance in kind of ESG through the ESG lens. So I'll just pause here.
Thank you for doing that. I mean, yes, I'm probably guilty of spending too much time focusing on the US and Europe and not nearly enough on what's going on in the Asia Pacific region. So thank you very much for that, Alicia. Paul, can I come to you next for opening comments?
Yeah, thank you very much. Just to give a little bit of background, I founded this business, Haven Green Capital Partners, and acting as CEO now. The rationale for founding it is I believe that there is a gap between the asset owners and access to strategies that actually can really make a transformative change to the climatic emergency that we really are all in. Though they're I think that everyone's presence here at this panel and tending to listen is probably a recognition of that. In fact, your criterion that you laid out, Simon, I think is actually a menu for the types of managers that we want to be working with. So what we're trying to do is help those managers who otherwise would not have been able to develop and get attention. So whether it's an emissions reduction, renewable energy, even going down to things like regenerative agriculture in the forestry and organic farming space, trying to bring those managers those implementers to the attention of asset owners so that they can actually reflect these values that you hear from these 52 pension funds. And I think actually one of the challenges for the pension funds today is there is not a ready menu of opportunity there to reflect all of those different standards that they actually are ascribing to. I do think we're in a super factor cycle. That super factor is going to be around both, I think, diversity being one. I noted on what you're doing. I also think it's a super factor around the whole area of low carbon and carbon reduction. The sad thing is that the world thinks that working off the existing indices and trying to just have a lower carbon count than the existing indices is the answer. It is categorically not the answer. In fact, that is a finance answer to what is a much more sophisticated problem. And I think what we're trying to do at Haven Green Capital Partners is bring that opportunity to those managers who actually can really change the outlook for the planet and for future generations. So that's what we're trying to do. No small task, but we feel we have to do our piece, and that's the exciting bit of it for everybody who's joined in on Haven Green Capital Partners.
Well, as you say yourself, that's an enormous task you set yourself. So good luck with that. So Nick, please can I come to you for opening comments, and I'm going to ask you the first question with regard to emission reduction. So over to you.
Certainly. So hello, everyone. My name is Nick Fosterman. I'm the founder of CIO of Integrated Portfolio Intelligence, or IPI. We're a New York-based investment manager. We're a quantitative investment manager with a focus on fundamental analysis and quantum mental models, if you will. We're very active across the commodities and the macro markets in general. So not so much in single name equities, but really broadly across macro and commodities, and particularly across all the sectors. Environmental macro has been an area of focus for us for quite some time now. And one of the things that we've realized sometime, quite a while ago, is that globally, the concept of the energy transition, all the dynamics around energy transition and the emergence of carbon markets having a very significant impact already today on the fundamentals of many commodities. So that really triggered a lot of the research that we've done. And, we've looked at all the global commodities. We've looked at all the major sectors that contribute globally to carbon emissions, starting with power generations and transportation and heavy industry, cement and steel, heavy contributors. We've looked very closely at agriculture and deforestation. And again, we've looked closely at how do they impact the emergence of macro markets, but similarly, how is the transition and the fact that carbon markets exist and new policies and regulations, how do they already impact the dynamics and supply and demand of commodities today? And actually the effect is quite significant. So what started out as kind of an interesting body of work turned out into kind of a mainstream area of research. And recently we've just completed a primer that's available upon request, where we essentially summarize some of the findings and the dynamics that we've identified, and we continue to integrate into existing investment programs.
Thank you. So, and let me stick with you, Nick, and ask you the first question, which is, why do you think that emission reductions is the preferred investment category of the investors we did research with? It's out number one not by a massive margin. Renewable energy is not far behind, but it's clearly very, very popular amongst the institutions that we were researching. What's your view on that?
Certainly. Well, clearly, I mean, talking about ESG broadly, it's been said that E, or the environment pillar, is probably the most critical pillar. And part of that is because there is a scientific component. There's broad awareness and consensus around, climate change and the impacts on the world in general. Clearly, when you look at how do we address that issue, when you look at all the transition scenarios that are out there, and we consistently consolidate and compile transition scenarios from numerous global reputable kind of organizations, there's clearly a critical path. So to get to anything that remotely resembles net zero, whether it's 2030, 2040, or 2050, there's definitely a critical path, and there's definitely a path dependency. So we need to start doing something about that today. We need to meet short-term milestones in order to accomplish some of the longer-term goals. So there's clearly an urgency to that. There's really a time component to that. I think when you look at the different scenarios that exist to get to net zero, they all have different implications. Certainly the most aggressive scenarios imply that there are quite a few advances in technology. So technology is a very important component. But again, We have some existing technology today. There's some R&D that's going on, and there's certainly a time component to that. Reducing emissions of CO2 or greenhouse gas emissions in general, which are expressed in some sort of a CO2 equivalent, is something that we can and should do today. So there's definitely an urgency to that, and we can certainly do something about that. And when we think of kind of CO2 reductions, there's sort of two components to that. The first thing is really understanding the emissions intensity of different operations of different businesses, and even though that area would appear to be mature, certainly on a global scale, there's a lot of room for improvement. Some folks are just starting to understand the differences between scope 1, 2, and 3 emissions, where scope 1 emissions are kind of like direct emissions from one's operations, and scope 3 really captures the entire supply chain, upstream and downstream. But those are important components to understand. So there's definitely an education component that's happening very rapidly, and by understanding the emission intensities, from different stages, from different components. And that's important because, understanding the life cycle of commodities, understanding the entire downstream and upstream emissions from different operations, from different value chains, implies that we can look at some sensitivity analysis. And oftentimes changing some supplies, oftentimes making relatively small operational changes can actually have quite a significant impact on carbon emissions today. And again, the importance there is to look at the entire value chain, understand scope 3 emissions. A lot of businesses, a lot of operations may not be aware that they're actually contributing to deforestation. That's definitely not scope 1 for many folks. In fact, when you look at most firms out there, I would say with the exception of utilities and airlines, the vast majority of their emissions are actually scope 3 emissions. And oftentimes it's an order of magnitude greater than direct emissions. Not all firms report those emissions, but again, there's an improvement, continuous improvement in that, and that's critical. So understanding the CO2 intensity from different activities and trying to make some operational changes is obviously something that's very critical and very important. There are a lot of policies and regulations in place, but I think increasingly investors are going to be holding firms accountable for some of that sensitivity analysis. So that's something that we can do today to already make a short-term impact. I would say the other component of net zero, in addition to kind of operational, reducing your carbon intensity, is really tapping the financial markets in terms of offsets. So again, in order to get to net zero, there are two components: the operational component and some sort of a carbon offset. And that's a really interesting area that's grown significantly in the financial markets. We've seen quite a bit of growth in liquidity and diversity geographically and across different allowance markets. In addition to that, there's sort of voluntary markets, the voluntary offset markets. More recently, we've seen some exchange-based benchmarks that are emerging. And these are all very positive steps. And in fact, those markets are moving quite rapidly. And increasingly, we think of carbon really as a standalone, as a new asset class. And it's beginning to exhibit all the characteristics that institutional investors, I would say, desire in an asset class. Increased liquidity is there, again, because of the emergence of benchmarks, because of the emergence of exchange-traded derivatives. The diversity is there, and increasingly the transparency. So as benchmarks emerge, different projects globally with a number of different attributes that may seem very complex to kind of understand can be expressed in financial terms as relative spreads to benchmarks. So as that emerges, as we start pricing some carbon projects or markets as a spread to benchmarks, that increases a great deal to transparency.
That's fascinating. Carbon as an asset class.
Absolutely.
Looking forward to that. It'll be a lot of fun to write about that and have debate on that in the future.
Well, I'm certain we're going to be talking about that. But again, I think for pension funds, for the large institutional investors, participating in carbon markets as an asset class, it's definitely a returns-based thesis. So there's definitely a very convincing kind of a short-term, medium-term, and longer-term investment argument for that, purely based on economics. Again, when you look at all the global transition scenarios, the more aggressive scenarios, all else equal, will require kind of a higher break-even or higher margin, a higher price for carbon globally. So clearly, under any scenario, generally, obviously, the transition is expected to be volatile, It's certainly not going to be linear. There definitely will be a number of kind of setbacks. Obviously, numerous participants, countries are involved. There are geopolitical and other considerations with respect to energy and food security and so on and so forth. So we certainly don't expect the transition to be linear. We don't expect the price of carbon to increase every day, but we do expect to see longer term appreciation. And again, for investors, the interesting thing is with the more transparency into the markets, there's more transparency into the dynamics on those markets. So again, they can participate in carbon both structurally, kind of, perhaps in a long index, diversified index form, but also in active form as the dynamics of some of these markets are becoming more apparent and more observable. And also, so in addition to, I would say, the economics-based thesis, there's also an ESG component. Certainly participating in those markets for the large institutional investors will only increase market efficiency, liquidity, and price discovery. And certainly having the right price of carbon for the global benchmarks and for other kind of projects and offsets that are priced off of that, having the right price of carbon based on true sort of supply and demand fundamentals is absolutely critical. And increasingly pension fund participation is not just, again, for them, it's not only interesting from a pure economics background, but there's also an important ESG component in increasing the liquidity, the transparency, and the price discovery in those markets will facilitate us, all else equal, we believe, a smoother transition to a net zero world.
Thank you. Karina, can I come to you and ask you, what does the emission reduction actually cover? You mentioned methane, CO2, other gases. Can you touch on that?
Yeah, indeed. So, I mean, as Nick said, we hear a lot about reducing the carbon footprint, and the footprint is the total greenhouse gas emissions expressed as a CO2 equivalent. And so emissions includes not just CO2, but also, of course, methane and nitrous oxide. So, I mean, CO2 emissions are fairly predictable and they tend to arise as a result of human or business activities. And so reducing emissions from CO2 is usually something that can be planned and managed. And whilst CO2 accounts for around 3/4 of the warming impact of greenhouse gas emissions, cutting methane emissions is actually the fastest opportunity that we have to immediately slow the rate of global warming. So methane has more than 80 times the warming power of CO2 across the first 20 years after it reaches the atmosphere. And it's currently increasing at a rate of around 1% per annum. It also tends to be fugitive, escaping through the extraction, transport, storage, and processing of fossil fuels. So even though CO2 has a longer lasting effect, methane sets the pace for global warming in the near term. For many years now, methane has been overlooked in the climate conversation, but there is increasing recognition that methane reductions will be crucial to slow global warming and to avert climate risk. And so when we launched our first satellite in 2016, our demonstrator satellite, we aimed to measure both methane and CO2 and rapidly came to the conclusion that the importance really lay in the measurement of methane emissions, matched, of course, to the need of our customer. And I mean, also, if you think about COP26, it was a little bit of a mixed bag in terms of impact, but it did deliver the global methane pledge to cut emissions by 30% by 2030. And so, I mean, finally, if you consider the emissions from UK pension funds investments alone, there's around £100 billion invested in fossil fuels. I think there is a need for a clear approach to track and measure and monitor a reduction in those emissions whilst at the same time diversifying the growth portfolio.
Okay, well, before we move on to other areas, how can you track this very emission reductions?
So, I mean, the first question I would ask is tracking for what and tracking for whom? I mean, as Paul said, the current vast range of standards, guidelines, and regulations, it means that there's no single measurement methodology. And very often there's no requirement to validate emissions disclosures. And yet we see investors with global portfolios increasingly calling for high quality, transparent, reliable, and comparable reporting by companies on climate matters. And then added to that, this year we see SFDR requiring the reporting of portfolio emissions. So, I mean, whilst there is some hope that the International Sustainability Standards Board, with its new offices around the globe, will put some structure around sustainability reporting standards, public consultation, of course, is now underway. But how soon can we expect to see something tangible coming out of that? And so at a company level, by and large, we see companies working to establish some kind of baseline, perhaps using an emissions audit, to set reduction targets in line with regulatory or other commitments, maybe to assign an executive sponsor or link those targets with executive remuneration. Sometimes they'll sign up to a structured initiative like science-based targets. Maybe they'll make a big announcement, and then by and large do what they can to track and measure their emissions. So some will do their own calculations and others may look to data specialists like us. And then they'll report on those outputs in their annual disclosures. But I think for the investment industry, one of the biggest challenges is the lack of information on the financial impact to the company of not achieving those targets and the transition risk that comes with transitioning to that low emissions model. So it's not just about using emissions data to track and report on whether the targets are achieved. It's about leveraging the data to model and report on scenarios where the targets are not achieved.
Okay, thank you. Now let's broaden this out a little bit. Time is galloping on. Can I come to you, Felicia, and ask you this very big, broad question? Bit simplistically put, perhaps, apologies for that. Which is better? Broad ESG investing done across different pillars. I think a lot of the ETF investing is in that category, which has gone absolutely bananas recently. It's gone vertical. It's just gone crazy. The London Stock Exchange probably knows a lot about that. So broad ESG investing done across the different pillars, or the specialist approach. We've been talking in quite a lot of detail here about emission reduction. So that kind of granularity into one area. What are the pros and cons of each approach? You're muted.
Oh, yes, sorry. Yes, I love this question because I could actually debate myself all day on this question. But let me try and be brief, and I think I'll distill it to two things I want to talk about. One is investment objective, and the other part is rigor. So I think investment objective, I mean, the kinds of people that we see in LSEG and, kind of in labs, they'll have different objectives. So for a pension fund or sovereign wealth fund, I mean, having the returns together with the risk management and diversification are very important. Then if you come across like a family office or a faith-based or ethical investor, their belief systems are very important. So those may necessitate much more stringent exclusions, much more targeted, even a sectoral focus. So you have family offices, maybe they've made their wealth through agriculture or agri-food, and therefore they want to look at, the emissions reductions, the social justice around agriculture and food. But having said that, many of them have a common goal now of fighting climate change because, as I think Nick pointed out, there's so much urgency and so much science behind that. That is the near-term danger. So having taken that into account, the investment objective will control how targeted and how granular they want to be. But I think the key issue here, and that's the second part I want to talk about, is rigor. Because I think we're all afraid of greenwashing, or now rainbow washing, as they call kind of funny business in the SDGs, the Sustainable Development Goals. And you need to have an appropriate level of ambition, and you need to have ways to check and make sure the targets are met. So this speaks to a lot of the good points that Karina made on verification and accountability. Now, I just want to make a little bit of a statement on, criticism of indices. Now, what's the main criticism of indices is that one very funny thing I heard was that it's just a beauty pageant and all the contestants are the same. They're just standing in a different order, right? But the reality is that you can actually apply rigor to indices by making them targeted indices. So some of them which are based on carbon intensity effectively drill down to, the emissions intensity, which I think Nick alluded to. Or you could have indices around even things like gender equity, like the number of women on boards, how proactive they are. So I think as long as we have rigor, and that includes the measurement, the monitoring, the verification, improvement, because year on year, we've got to hit increasingly stringent targets to meet the climate challenge, then you'll be able to solve that problem. And it's not a matter of indices, sectoral, broad. It's about how definitively we can say we trust the numbers, and we think that people can act upon these numbers. And Karina talked about the benefits of remote sensing and Earth observation, and there are tools that you can layer on top of that. Analytics, looking at news, bringing in information from watchdogs, associations, and analysis from organizations such as yours, Simon. So there's a lot of work that can be done in this area, and to figure out whether you want to look broadly or narrowly, you just have to be extremely rigorous about it. So I'll just stop here.
That's very interesting. I can see it. There may already be one, as far as I don't know, a fund out there that invests only in companies where the majority of the people on the board are female or something like that. So interesting. Paul, can I come to you? Do you think the industry can reach or arrive at or develop or get on a journey towards greater investment categorization? Because particularly in terms of what you outlined at the beginning, you're going to be doing or are doing, that would seem to be quite important, I would have thought. Paul, I think you're muted.
So I think the answer quite simply is it absolutely has to. And I think as I listen to the panelists going through it, there's so many points I agree on there. I mean, I think when Karina's talking about measurability, I think the companies that are coming up with measurability factors today are going to be the companies that will dominate going towards the future, because it's all about new technology, about new way of thinking. And if we are not thinking differently, and we're thinking that we can repurpose existing long-only products or existing strategies and just find a couple of metrics that actually say that what we've been doing is actually good all along, I think actually that is the ultimate cop-out. And yeah, you asked the question, are there funds out there that are focused on diversity? Yes, there are funds. Sadly, we have funds that have to absolutely focus on diversity. I mean, honestly, we shouldn't have funds that focus on diversity. We should have an industry that focuses on diversity. So
well, the fund industry does not do diversity. Yeah. This is one of my specialist subjects, I can tell you.
Yeah.
The D&I index only has one fund manager out of the top 100. Sorry to interrupt you. Go ahead, Paul.
Yeah, no, but it's my criticism of it. And I also am incredibly afraid of carbon pricing being done in a way that actually involves financial engineers who are successfully took us through a global financial crisis, successfully probably convinced us that in the dot-com boom that we should have buy freshair.com along the way. I think there is a huge danger that when it moves into that sector, that we will have, like, so Nick and teams like that, and bring in their intellectual rigor to challenging that is going to be vitally important for the industry on a go-forward basis. And ultimately, when it comes down to it, and your point on the diversity managers inclusion in the top 100 is absolutely on the money. But I think if we're doing the same thing as we've been doing for the last 50 years in the asset management industry in the next 5 years, then the one huge powerful tool that we have that actually can really make a change to this climatic emergency that we find ourselves in, which is capital, asset owners directing towards appropriate strategies that can deliver real world outcomes that actually make a meaningful difference and don't just tick a box that says that I'm doing something. So that to me is the ultimate element of virtuous signaling that's going on in our market today. So if you think about renewable energy today, how do you invest in that? Ultimately, that's one of the greatest LDI assets you can invest in. Cut out the middleman, directly invest in the real asset itself. Take the long-term yield into the pension fund and give it to the benefit of the pensioners. To me, how you actually approach renewable energy, if we think we find one manager that will actually deliver us a global renewable energy strategy, frankly, I don't think it really exists out there. These are national security assets. These are assets that are over a 25-year period. You have to approach how you invest in that space differently. And I think it's the same thing for emissions. And sorry, I will just get off my soapbox in just 1 second on it. I actually think we all have to realize that we are in a super cycle when it comes to investing right now. And this super cycle means that there are factors that we have not given attribution to before that are going to matter more going forward. And it is around emissions reduction. It is around diversity and inclusion. We tend to call them inside at Haven Green, we call them the super factors. And trying to find managers that are facing off against those super factors, because they are actually where the real source of returns that will justify the movement of this capital are going to come from on a go forward basis. And that it's exciting, but it means that we're going to be relying on a whole different set of skill sets perhaps than we have heretofore. We're going to rely on organic farmers. We're going to rely on foresters. We're going to rely on people who have not been ordained to the investment management industry and the delivery of alpha over the last few years. And I think this is so important that we begin to think there's questions that are coming in about ESG but ESG itself is become more of a broad brand. I think it just is. It's too wide. It actually comes down to, as you're finding out with these classifications that have come out from those pension funds, emissions reduction, renewable energy, water biodiversity, regenerative agriculture, diversity and inclusion. These are the super factors that we should all be facing portfolios off against and managing against in terms of the benefit for the long term for pensioners and future generations.
Thank you. We're already, shockingly, we haven't got very long left. Nick, I'm going to come to, I see we have two, in fact, we kind of got three questions in here, and I'm going to put, maybe I should read out both questions and anyone can take, I'm going to ask Nick to have first go at these, but I'm going to read them both out at the same time. We'll just see where we go. One of them is, what are the advantages and disadvantages of combining ESG into one category? Felicia actually kind of half touched upon that, not really, but a bit of that. Then secondly, someone's asked, do you have information on how much or whether institutional versus allocations to ESG strategies is changing or growing? I'd be interested in anyone's views on both of those. Actually, there's also a question in the chat from somebody, do your categorizations relate stroke map to the UN Compact 13? Nick, do you want to answer any of that?
So I would normally take the ESG question. Felicia did such a great job answering it. It was very well articulated. There's not much to add. I mean, I think that's definitely a field that's still evolving. I don't think there's one answer to that. I think in talking to different industry participants and investors, there are a lot of different strong views, there are a lot of different schools of thought. So I think over time, frameworks will evolve. I think when you look at some alternative markets, even taking commodities as an example, if you're buying, for example, if you bought a crude oil ETF, does that have a carbon intensity attached to it? Some would argue no, because it's probably linked to a futures contract, and futures are just derivatives. They have no carbon intensity. It's not a physical asset. Others would argue that's not the case. You need to understand the carbon intensity of crude oil and pair it with cost of carbon, and that's the true cost. So there's different schools of thought that would lead to different investment decisions that would ultimately lead to a particular structure to be allocated in different buckets. So again, our focus is away from the equities and in the macro markets, and we find that all investors are really thinking about the implications of macro and commodity markets, and for many it's still new and evolving. and we're having a lot of very interesting discussions, but certainly an evolving field. I don't think there's, certainly outside of the equity space, not a great deal of consensus, even on some very basic things. If you're investing in futures, does that have any carbon intensity associated with it? And you hear different answers depending on possibly some conflicts of interest, but in both cases, there are arguments that in both ways. So again, it's an emerging area. We're having some really interesting discussions about it, but ultimately it's tied to investment objectives, and that's going to lead to the design of particular structures and the allocation. So you certainly need to look broadly at your entire portfolio as well.
Does anyone else want to comment on either of those two questions? I'll put my hand up actually to answer the second one there to a certain extent. Anybody else can come in after this?
Jump in?
Sorry, go on.
Sorry.
Please
go first. Yeah.
Sorry, go ahead.
Oh no, I just wanted to quickly address the one about the advantages and disadvantages. Actually, there's two related or kind of two end members where people do want to look at multiple factors at the same time. And that's because a single project or an entity might be doing things that both satisfy, say, renewable energy and social justice, or poverty reduction. So we see a little bit of that in impact investing, as well as kind of bespoke indices for ESG. But the other extreme, people sometimes also want to consider the holistic ESG, because they're worried that even though a company performs very well in one area, they'll perform really badly in another one. And I won't name names, but you do hear of tech companies which on the surface might be doing interesting, making interesting investments in renewable energy, into innovation, into low carbon transport, but then they have very bad records in how they treat their staff and things to do with diversity and inclusion. So there are investors who want to be able to see the big picture, not to kind of greenwash, but to make sure that the balance, overall balance, is kept. I'll just stop there. Yeah.
No, I'm not going to allow you to stop there. That's a very interesting comment you've just made about the fact that you can have a company that's producing a very good product, but has on the governance side has got an atrociously bad record. I guess, as you were implying earlier on, it sort of depends on what your priorities are as an investor, whether that matters to you or not. The trouble is how on earth anyone's really going to know? And these things can change so quickly, and you're making an investment decision for years, presumably. Trying to combine these things is just almost too difficult, even if it's worthy.
It's true. And I'm going to stick my neck out a little bit. So I think there are certain groups of ESG factors where you don't see investors maybe scrutinize so much. Maybe things to do with poverty reduction and social justice. But I think increasingly, and this might speak a little bit to the second question, you do see a lot of emphasis on saving, Earth from itself, which is basically rescuing us from this climate situation. So there is an urgency around climate and environment that you don't necessarily see in some of the other areas, not because they're not important, but because it's just, you've got to pour water on the nearest fire, and that happens to be climate change.
Yeah, that's a fair point. I'm going to, anyone else want to comment to those questions? I'd like to comment on the second one, but anybody else want to say anything?
Just one point, Simon. I think, certainly from an ESG perspective, that the ESG label has served us pretty well, during the pandemic years. If you think back over the last couple of years where, the term ESG has really accelerated and as we all became interested in climate impact and people and community and good corporate governance. But, I think as we go forward, previous methodologies and labeling really does need to be adapted, to fit not just with the demand for the market for more and better information on ESG credentials. And I'm loving Paul's super factors. But,
that's
also
definitely going to catch on. Yeah.
I'm going to use that. But, also to serve the needs of the customer. And at the end of the day, the customer is the investor.
Yeah. Well, talking about investors and the customer being the investor, somebody's asked, as I read out a few minutes ago, do you have information on on how much or whether institutional investors' allocations to ESG strategies is changing or growing. I mean, correct me if I'm wrong, either somebody in the audience fire something in or one of the members of the panel. I've seen incredibly little on that. Maybe I'm looking in the wrong place. I just have seen amazingly little, which is why this is an opportunity for me to test out what we're planning to do this year in this part of our business as to whether or not this is something that we can do. How difficult it is to get hold of the information, I don't know. Go ahead.
So, yeah, I think on that one, look, there is you got to separate the two, what's happening. There is certainly a huge movement of assets towards strategies where the labeling is around the ESG space. The question we have to ask is it the labeling that's actually attracting it, or is it the underlying conscientious investing strategies that are there? And I think actually the challenge here is that, this is not a marketing exercise, nor should it be. And I think that that's the large challenge that the industry has to deal with. So I'm excited at the outcome and actually of your survey, what people are focused on here, because I think instead of GICs that people should be thinking about when they're thinking about the classifications, these are the new GIC standards that I think the world and the industry should be facing off against. And I'm sure they will be refined around this. And you will see, as you mentioned, the ETF growth and ETF and emissions reduction. I do say, and I'll go back to my financial engineering point, the one thing I would add to it is I think the greatest protection we can have is ensuring that there's a proper and appropriate accountability around collateralization between any financial engineering that takes place. So if we're going to reduce carbon, let's just make sure there's forests being planted. Let's just not make sure that it's some correlation effect to some other asset that says that this will happen. That is what we have to avoid in this market. So I think money is moving towards it, but I actually would be skeptical that where it's going is going to be where it's going to be going in 3 to 5 years' time. I think there's going to be much more sophisticated outcomes coming. I think the whole area, as Nick has alluded to, of AI and machine learning in this space is actually going to become more and more important. The use of different people delivering metrics is going to become increasingly important. Repurposing tools we've had may not be the answer, and in fact, in a lot of circumstances, will not be the answer. So I think the industry itself should see that we are at this eclipse moment where there has to be a transformative change, or a new industry will emerge, and it will basically eat the lunch of what we've had before. And I think it's just really important that the industry does adapt to this right now. So while the money is moving, I suspect that the real revolution is still only in the early phases as to how the industry is going to look. So the start of your process on your research is probably apt in terms of timing, because I think there is going to be something interesting on a regular basis coming out in this space that new and innovative and different styles of thinking that are going to make it, make for better and better outcomes, I hope, on a go-forward basis.
I think that's an extremely good statement to end on. Hopefully, you're right, Paul. We'll see what happens. It's one thing I don't think anyone can possibly deny. It's absolutely fascinating. It's incredibly complex on one level, but the sort of the dilemmas that Felicia particularly touched upon are there, and I don't know whether they can be resolved, but they're really worth digging into and looking at. And at least to come back, at the risk of repetition, what we're going to do is try and get a much better sense than I'm aware of that exists today on where at least institutional allocations are going in terms of into the different categories. And if we could get some broad consensus on what those categories are, that will be helpful to the cause as well. Well, thank you all very much from around the world for joining us today. I hope you found that useful. There will be, somebody's asked in the Q&A whether there will be a recording. Yes, there will. There'll be a recording of this going up probably in about 3 or 4 days' time, probably sometime early next week. If you'd like to see the ESG report with the full details of the research I've presented, the highlights of, then do let us know. We'll get that to you. Thank you, panel, very much for covering a huge amount of ground in a very short period of time. I think we've delved into a huge amount of detail, particularly on emission reductions, and then done the broader stuff as well. Have a very good morning, afternoon, or in Felicia's case, it must be coming up to about midnight where you are. Have a very good night's sleep wherever you are in the world, and hopefully see you the next time. Bye-bye, everybody.
Thank you.
Thanks very much. Bye-bye.